Right now, institutional money is quietly positioning itself around Hedera. Grayscale's HBAR ETF decision drops November 12th, and the SEC cannot delay it anymore. But here's what nobody's talking about. While everyone's celebrating ETF launches and Bank of England partnerships, HBAR's price chart is screaming danger, hidden bearish divergence, capital outflows, institutional exit signals. So what's really going on? Are we watching smart money leave before retail arrives, or is this the perfect storm before a massive breakout? Let's decode the data. What's up, crypto fam? Welcome back to the channel. If you're serious about understanding what institutional money is doing while everyone else is distracted by headlines, you're in the right place. Smash that like button, hit subscribe, and turn on notifications. Because in this market, timing is everything, and I'm bringing you the analysis that cuts through the noise. Here's where we are. Nasdaq filed the 19B4 form months ago for Grayscale's spot HBAR ETF. The SEC just extended its review period, and November 12th is now the hard deadline. According to regulatory experts, this is it. No more extensions allowed. The commission either approves it or rejects it with a full explanation citing investor protection concerns or market surveillance issues. And if they reject it, Grayscale can appeal or refile. But that deadline, it's set in stone. Now, why does this matter? Because once approved, everyday investors get regulated access to HBAR through traditional markets. We're talking fidelity accounts, retirement portfolios, institutional desks, the whole apparatus of traditional finance getting direct exposure to Hedera. This isn't some random altcoin anymore. This is institutional adoption in real time. But, wait, something's not adding up here. While we're all watching the ETF countdown, the price action is telling a completely different story. Between October 6th and October 31st, HBAR made lower highs while the relative strength index formed higher highs. Technical traders know exactly what this means. Hidden bearish divergence. Translation? The downtrend isn't just continuing, it's being reinforced. The RSI measures buying versus selling pressure, and this divergence reveals that buyers are losing control even when the price attempts small recoveries. HBAR is down nearly 13% week on week, despite being in the green zone daily. Month on month, we're looking at validation of a sustained downtrend. So institutions are preparing for an ETF launch, but the chart is flashing red. Someone's not telling the whole truth here. Now check this out. The Chaikin Money Flow indicator, which tracks where big capital is actually moving, has been making lower highs since October 28th. It just dropped below zero to negative 0.09. That's not retail panic selling. That's institutional money walking out the door. Large holders are exiting, building the exact selling pressure that's keeping HBAR underperforming, while everyone's celebrating partnerships and ETF news. So what's actually happening behind the curtain? Let me give you my analysis. We're witnessing a classic sell the news setup disguised as bullish fundamentals. Yes, the Canary Hedera ETF launched with nearly $8 million in inflows, crushing Litecoin's measly $1 million debut, according to Bloomberg ETF analyst Eric Balkunas. Yes, Hedera just got selected for the Bank of England's Distributed Ledger Technology Innovation Challenge, alongside the Bank for International Settlements. Yes, Hedera is dominating real-world assets development with Chainlink, IOTA, Avalanche, and Stellar. And yes, they're powering the first tokenized upstream oil and gas fund through Zonix and One World Petroleum. But here's my expert take: institutional players already knew all of this. They positioned early, accumulated at lower levels, and now they're distributing into the excitement. The negative CMF readings don't lie. Smart money is reducing exposure, while retail is reading headlines about Bank of England partnerships. This is Crypto 101, buy the rumor, sell the news, except the news is an ETF approval that everyone's treating like a guaranteed moon mission. However, and this is critical, the 4-hour chart is offering us something interesting. Between October 31st and November 2nd, HBAR's price made a higher low, while RSI made a lower low. That's hidden bullish divergence on the lower time frame. It doesn't reverse the broader bearish structure, but it suggests short-term buyers might be stepping in for a quick scalp opportunity. If HBAR manages a clean close above 20.4 cents, a level that's rejected price repeatedly since October 30th, we could see a brief relief rally toward 21.9 cents. That's your next resistance zone, and honestly, it's where I'd be taking profits if I were swing trading this bounce. The key word here is brief. This isn't a trend reversal, it's a potential dead cat bounce in a confirmed downtrend. But, if HBAR fails at 20.4 cents and drops below 18.9 cents, we're looking at further declines towards 17.8 cents and potentially 16.8 cents. A daily close below 16.8 cents would completely invalidate any rebound setup and confirm the downtrend is firmly in control. At that point, even the ETF approval might not save the price action short term because the technical damage would be too severe. Now, let's address the massive question everyone's asking: why would institutional money exit right before an ETF approval? My theory: they're expecting a buy the rumor, sell the news event, or they're repositioning for better entry points after retail FOMO drives a spike and subsequent crash. Remember, institutions don't trade emotions, they trade probabilities and risk-adjusted returns. If they see better opportunities elsewhere or expect short-term volatility, they'll exit even before positive catalysts. Another possibility I'm considering: smart money knows something about the SEC's November 12th decision that we don't. Maybe they're pricing in a rejection or delay despite the final deadline narrative. Or maybe they've already priced in approval and the actual event won't move the needle as much as everyone expects. This happens constantly in crypto. Massive catalysts get front-run so hard that when they actually occur, the price dumps. Here's what makes this situation particularly fascinating. Hedera's fundamentals are genuinely impressive. The real-world assets dominance, the Bank of England partnership, the tokenized oil and gas fund. These aren't pump-and-dump narratives. These are legitimate enterprise adoption milestones. But price action doesn't care about fundamentals in the short term. It cares about supply and demand. And right now, supply from institutional sellers is overwhelming demand from retail buyers. So, where does this leave us? November 12th is the date to watch, but don't let the ETF hype blind you to what the charts are saying. Hidden bearish divergence, negative money flow, and institutional selling pressure are real technical signals that demand respect. If you're trading this, watch that 20.4 cent level like a hawk. A clean break above could give you a quick scalp to 21.9 cents, but manage your risk aggressively because the broader trend remains bearish. If you're a long-term holder betting on institutional adoption through ETFs and enterprise partnerships, this weakness might actually be a gift, accumulation zones disguised as fear. Just don't confuse a long-term thesis with short-term trading decisions. The market can stay irrational longer than you can stay solvent, especially in crypto. Thanks for watching, fam. If this analysis helped you see past the headlines and understand what's really moving the price, show some love with a like and drop a comment with your HBAR price prediction for November 12th. Are we bouncing to 22 cents or crashing to 16 cents? I want to hear your take. And if you want more deep dive technical analysis on altcoins everyone's talking about but nobody's analyzing correctly, check out my other videos. Don't forget to subscribe and hit that notification bell so you never miss an upload. Let's stay ahead of the curve together. Quick reminder, nothing in this video is financial advice. Cryptocurrency trading involves substantial risk, and you should never invest more than you can afford to lose. Always do your own research, understand your risk tolerance, and consider consulting with a financial advisor before making investment decisions. The analysis presented here is for educational and entertainment purposes only. Stay safe out there and trade smart, not emotional.